pence and 56 pence sterling. Interest rates up, unemployment down. That's the top line of this week's economic news.
So what's next? Does the fall in the jobless total mean the forecast additional rate rises are now a lay-down misere? Rod North from the investor relations company Vorse Communications joins us now. Rod, thank you very much for joining us.
Good morning.
What should we expect? Is it a lay-down misere? Will we get those rate rises?
Well, look, I think what we've got to look at is we've seen 1 month of positive jobless figures come out, which has meant that the rates dropped from 5.8 to 5.7. And I think it's interesting because most analysts were predicting that the jobless figures would go up, but they didn't. So it seems as if perhaps the Reserve Bank might have had a heads up on this ahead of their announcement earlier in the week on Tuesday in respect to interest rates. And I think in terms of rates, I think the market has always expected rates would be going up at some point in time because we're in a recovery cycle now and we've had the rates at emergency settings. They need to move back to neutral and then back to normal settings, which happens as we go through the recovery. But of course what we've seen is we've seen positive jobs figures, we've seen the rates start to go back up, and I think there's an expectation perhaps by the wider community that maybe rates could have held off a bit longer before we started to see them move. And of course the pressure now is to see the rates increase ahead of the end of the year, which sort of unfortunately finishes the year off with a bit of a sour note for a lot of people who perhaps are still trying to get back on their feet.
You point out there we have heard people complaining about this rate rise, but we have been warned over and over that rates will have to rise eventually. Do you have any sympathy for people who are complaining that rate rise was too early?
Well, I do, because I think, Joe, the sort of wider community, when you look at businesses, their overdraft rates have still not necessarily dropped significantly. I mean, the interesting statistic is when the rates peaked last September in 2008 at 7.25% and dropped to 3%, which is a drop of 4.85%, only 3.85% of that was passed on by the banks. So that in itself meant that a lot of those individuals and companies didn't get the relief perhaps with their overdraft rates and things like that. So a bit more time perhaps could have elapsed before that decision could have been made.
So you think, though, that the signs are that it's pretty much inevitable that Melbourne Cup Day we'll get another?
I think that is pretty much an inevitability. But again, it's really watching the jobs figures, because the jobs figures themselves, when you look at them, it's all very positive in terms of what's coming through now. And we need about 20,000 jobs each month to keep the figure at the stable level. But what we've seen out of the jobs numbers is over 200,000 of those jobs were full-time jobs and have now changed to part-time, and they're still included in the statistics. So of course they're the same people that are earning less, that obviously have mortgages, that will still have to be paying their mortgage, and with rates going up, earning less is going to be a bit of a problem for them.
Yes, so how did you read that full-time, part-time split in these latest figures, and is it really an increase, or is it a Clayton's increase?
Well, I think it's the impact of it is that when people move from full-time to part-time, I think the key issue is they're earning less money. They still have necessarily the same commitments if they've got a mortgage. So the thing that becomes a tough impost for them is if rates rise, it's going to impact on them because they've got less money in their pocket. And that creates a real issue, I think, for a lot of people if rates really start to move up quite significantly over the next 6 months.
And was it a bit rich for the big banks to have passed this on so quickly when they haven't passed on previous cuts?
Yes, I think that's very unfortunate because they've all, the major banks have jumped on the bandwagon. I mean, the interesting thing is that the banks now have 90% of the market share in the mortgage market, whereas before the global financial crisis they only had 60%. So they've got a very significant, monopolistic position at the moment. We need a few more non-bank institutions to come back to keep them honest, I think.
Rod North, thank you very much for joining us.
Thank you.